Hi, this is Zak Mir, editor of Spreadbet Magazine, with a look at some key UK tech stocks in the wake of the recent weakness for this asset class over the past couple of months. And you can see on the chart of ARM Holdings that we've seen actually a decline since the autumn within a falling trend channel. You could actually probably argue that the top of the channel is higher than this, up to £10.20 or £10.30. But over the last few weeks in particular, we've seen an acceleration to the downside towards the floor of the channel, just under £8.50, and the low of £8.38 tying in with the February floor at £8.35. It's noticeable that for May we've been just above that £8.35 level, and that's led to a gap to the upside for the stock, powered by bullish RSI divergence in the oscillator as well. So the outlook here is for a recovery in terms of the recent break to the downside we've had. Probably a conservative target here would be back to the 200-day moving average at £9.64 over the next 2 to 4 weeks. The stop loss on the buy argument probably now sustained price action back below £8.50. Although with the latest gap, it would be rather surprising if the shares managed to pull back that far. On to CSR, and we've got another stock which has been battered quite hard recently. In fact, since the March peak, we've seen quite a decline from £8 down towards £5.50. It looks like we're in a falling wedge formation. That's a bullish setup here. Double bounce, triple bounce off this with the bear traps near this December support line. End of day close back above the 20-day moving average at £5.76 is probably a decent buy trigger if you're cautious on the stock. Otherwise, after two bear traps, it's probably enough for most traders to go long and be looking for a retest of the 50-day moving average at £6.48 as soon as the end of next month. Finishing off with Imagination Technologies, where all the bad stuff really happened at the end of last year. We had quite a punishing decline there from over £3 going into December, where the shares effectively halved. Extended base since December, 4 support points below £2, and now we're getting support coming in above that level. Probably the best way forward here is to regard the 10-day moving average as the trading stop loss. That's at 206, as we look to further gains towards the top of a rising January channel at £2.45. We've also got a multi-tested RSI uptrend line from April, which backs the idea that the shares could actually deliver some more upside, even if this is not the end of what has been quite a painful few months for the shares. That's it from me. See you again next time. More updates on spreadbetmagazine.com.